Two investors, same goal. One picks individual stocks and loses sleep every night. The other puts money into a single ETF and quietly builds, well, right now, $11.5 trillion sits inside over 8,000 ETFs worldwide. That's not a trend. That's a revolution, and most people still don't understand how it actually works. Let's fix that. This is an opinion. We pulled 30 years of market data, SEC filings, Morningstar, Portfolio Visualizer, ICI records, and ETF.com. We tracked expense ratios, tracking error, liquidity, and tax efficiency across every major fund. Every number you'll see is sourced and verified. No guesswork, no sponsored picks, just data. And what that data reveals about fees will genuinely surprise you. Before we get into the numbers, a quick note. Nothing here is personalized financial advice. Every investor's situation is different. Always do your own research before making investment decisions. Now, with that said, the data we're about to walk through is some of the most compelling evidence for ETF investing ever compiled. And it starts with one fund that changed everything. In January 1993, the very first US ETF launched with $6.53 million. It was called SPDR S&P 500, ticker SPY. Today, that single fund holds over $500 billion. That's not millions, that's 500 billion. One fund, 30 years. The growth of an entire industry started right there. But here's the part nobody talks about. In 2009, the entire ETF industry held $1 trillion. By 2024, that number hit 11.5 trillion. That's 11.5 times growth in just 15 years. For context, the US economy barely doubled in that same period. ETFs didn't just grow, they rewired how the world invests. And the reason why comes down to one simple thing: cost. Here's where it gets personal. On a $50,000 investment, a typical ETF charges you $125 per year in fees. A comparable mutual fund charges $250. That's $125 saved annually. Sounds small, but compounded over decades, that gap becomes tens of thousands of dollars. Fees are the silent killer of long-term wealth, and that's only half the story. Not all ETFs are the same. 75% of all ETF assets sit in equity funds. Stocks. Fixed income takes 17%, commodities just 4%. Most beginners never look beyond equity ETFs. That's actually fine for long-term growth, but understanding what's inside your ETF matters more than most investors realize. Because two funds can look identical and perform very differently. Wait until you see what happens next. Here's something mutual fund investors never get. ETFs trade live all day, just like stocks. Mutual funds? They only price once at 4 p.m. That means if markets crash at noon, mutual fund investors can't react until the next day. ETF holders can move instantly. Add in the lower fees, 0.25% average versus 0.5% for mutual funds, and the structural advantage becomes obvious. This number should end the debate. According to S&P's SPIVA scorecard, over 15 years, 85% of large-cap active fund managers failed to beat their benchmark index after fees. 85%. These are professionals with research teams, Bloomberg terminals, and decades of experience. And still, passive ETFs won. But here's the deeper question. Why do fees matter so much more than most people think? Here it is, a number that changes everything. Take $50,000. Put it in VOO at 0.03% expense ratio for 20 years. You end up with $186,000. Put that same $50,000 in an active fund charging 1%. You get $172,000. That's $14,000 gone, not lost in a crash. Lost to fees, silently. Every single year. So how does an ETF actually stay priced correctly? It uses something called the creation and redemption mechanism. Big institutions called authorized participants can create or destroy ETF shares by swapping the underlying stocks. If an ETF trades too high, they profit by selling it down. Too low, they buy it up. This arbitrage keeps ETF prices honest around the clock. And that's exactly why the next slide matters so much. 6 funds dominate American investing: VOO, VTI, SPY, IVV, SPLG, and QQQ. VOO and IVV each hold roughly $550 billion. SPY holds over $500 billion. QQQ tracks the top 100 non-financial NASDAQ stocks with a 0.2% fee, nearly 7 times more than VOO's 0.03%. Same category, very different costs, and very different outcomes over time. $10,000 invested in QQQ grew to $120,000. The same 10,000 and S&P 500 ETFs, like VOO, grew to 72,000, and that's a $48,000 gap from one fund choice. But QQQ also crashed 35% in 2022. Higher reward, meaningfully higher risk. The question is, which one actually wins on a risk-adjusted basis? Risk-adjusted QQ plays with a Sharpe ratio of 0.94. VOO, SPY, and IVV all sit at 0.86. VTI comes in at 0.83. What's remarkable is how close these numbers are despite very different portfolios. QQQ charges nearly 7 times more in fees, yet it still wins on efficiency. That raises a real question about whether broad diversification is actually serving you. But there's a catch. Every single one of these 6 funds lost approximately 34% in the same 2022 crash. On a $50,000 investment, that's a $17,000 paper loss. Overnight, S&P 500 ETFs recovered within roughly 18 months. QQQ took longer. Yes, QQQ outperforms long-term, but can you hold through a 35% drop without panic selling? That answer matters more than any return number. Here's the macro context most ETF videos skip entirely. Interest rates and inflation don't just affect bonds. They reshape which ETFs win. When rates rise sharply, as they did from 2022 to 2023, growth-heavy funds like QQQ feel the most pain. Inflation erodes real returns across the board. Understanding the macro backdrop isn't optional for serious investors. It's the difference between timing your entry well and not. The 10-year Treasury yield is the invisible competitor to every equity ETF. When it climbs above 4.5%, risk-free government bonds become a genuine alternative to stock market returns. Why take equity risk for 7% when bonds offer 4.5% guaranteed? That's the pressure equity ETFs face right now. And it's exactly why the final comparison across all 6 funds is so important to see. Let's put it all together. VOO and IVV, 0.03% fees, $550 billion in assets, Sharpe ratio 0.86. SPY, nearly identical performance but costs 3 times more in fees. VTI, slightly broader, slightly lower Sharpe. QQQ, highest growth, highest fees, highest drawdown. SPLG, the lowest fee of all at 0.02%. The data is clear, but the right choice depends on you. Here's the final verdict from 30 years of data. QQQ grew 10,000 to 120,000. VOO grew the same to 72,000. That $48,000 gap is real, but held 20 years with $50,000, QQ compounds to 1.59 million. S&P 500 ETFs reached 699,000, an $890,000 difference. From one decision, one fund. Now you know what an ETF actually is, how it's built, how fees silently destroy wealth, and what 30 years of data says about the best funds available. The next step is choosing the right one for your situation. And that starts with one more comparison you haven't seen yet. If this breakdown helped you, hit subscribe. We drop new ETF deep dives every single week, and you do not want to miss them.